Welcome back, mystery lovers. Today, we're stepping away from serial killers and dark alleys to dive into the murky world of white-collar crime. The 2000s were rife with corporate scandals, billion-dollar frauds, and greed on an unimaginable scale. In this countdown, we'll be uncovering the top 10 white-collar crime scandals of the 2000s, based on their impact, severity, and the level of deception involved. Let's jump in. 10. The Health South Scandal, 2003. Kicking off our list is the Health South scandal, one of the largest corporate accounting frauds in U.S. history. Under the leadership of CEO Richard Scrushy, Health South overstated earnings by nearly $2.7 billion between 1996 and 2002. Scrushy and his team manipulated the company's financials to meet Wall Street expectations, making it appear as though Health South was far more profitable than it really was. The scandal unraveled when one of Health South's CFOs turned whistleblower, exposing years of financial fraud. Although Scrushy was acquitted of criminal charges in the accounting scandal, his reputation took a massive hit. He would later be convicted in an unrelated bribery case. Health South's fraudulent activity left investors in ruins, with stock prices plummeting and the company nearly collapsing under the weight of its deception. 9. The Tyco International Scandal, 2002. Next up is the Tyco International Scandal, where CEO Dennis Kozlowski and CFO Mark Swartz embezzled over $150 million from the company. The scandal became notorious not just for the scale of theft, but for Kozlowski's lavish lifestyle. He spent Tyco's money on everything from luxury homes to a $6,000 shower curtain, and even threw a $2 million birthday party for his wife on a Mediterranean island. Kozlowski and Swartz disguised their illegal activities through unauthorized bonuses and stock sales. Eventually, their fraudulent schemes were exposed, and both executives were convicted of grand larceny, securities fraud, and falsifying business records. Kozlowski's actions tarnished Tyco's reputation and resulted in massive losses for shareholders. The scandal served as a sobering reminder of how corporate greed can run unchecked at the highest levels. 8. The WorldCom Scandal, 2002. In 2002, telecommunications giant WorldCom collapsed in one of the largest accounting frauds in U.S. history. CEO Bernie Ebbers led a scheme to inflate earnings by nearly $11 billion, primarily by capitalizing expenses that should have been written off as losses. This made WorldCom appear more profitable than it really was, artificially inflating the company's stock price and keeping investors in the dark about its financial health. When the fraud was uncovered, WorldCom's stock plummeted, leading to the company's bankruptcy, the largest in U.S. history at the time. Bernie Ebbers was convicted and sentenced to 25 years in prison for his role in the scandal. WorldCom's fall had far-reaching consequences, including thousands of lost jobs and significant losses for investors. The scandal also shook confidence in corporate governance and led to the passage of the Sarbanes-Oxley Act, which aimed to tighten financial reporting standards. 7. The Bernie Madoff Ponzi Scheme, 2008. Next on our list is Bernie Madoff's Ponzi scheme, perhaps the most infamous financial fraud of the 2000s. Madoff, once a respected figure on Wall Street, ran a Ponzi scheme that defrauded investors of an estimated $65 billion over decades. His fraudulent investment firm promised high returns with little risk, drawing in wealthy individuals, charities, and financial institutions. However, rather than investing the funds, Madoff used money from new investors to pay returns to existing clients. The scheme unraveled during the 2008 financial crisis, when market conditions made it impossible for Madoff to keep up with withdrawal requests. Thousands of investors, many of whom had trusted Madoff for decades, lost their life savings. Madoff was arrested, pleaded guilty, and was sentenced to 150 years in prison. The fallout from the Madoff scandal was devastating, with countless lives ruined and charities shuttered. It also led to a greater focus on regulatory oversight and fraud detection in the financial industry. 6. The Olympus Scandal, 2011. At number 6, we have the Olympus Scandal, which rocked Japan's corporate world in 2011. For over a decade, executives at Olympus, one of Japan's largest electronics manufacturers, engaged in a cover-up of nearly $1.7 billion in losses. These losses stemmed from bad investments made during the 1990s, which were hidden from shareholders and regulators through a complex web of fraudulent accounting practices. The scandal came to light when Michael Woodford, the company's newly appointed CEO, discovered the irregularities and blew the whistle. Olympus's board fired Woodford in an attempt to silence him, but the move backfired, and the scandal erupted into the public eye. The revelation of such extensive fraud shocked Japan's corporate sector and led to the resignation and prosecution of several top executives. The scandal also brought global attention to corporate governance issues, especially in Japan, where corporate transparency had long been questioned. 5. The Wells Fargo Scandal, 2016. Halfway through our list is the Wells Fargo scandal, one of the more recent entries. From 2011 to 2016, it was revealed that thousands of Wells Fargo employees had opened millions of unauthorized bank accounts and credit cards in customers' names. Employees did this under immense pressure to meet unrealistic sales goals set by the bank's leadership, which rewarded the number of accounts opened rather than their quality or necessity. When the scandal broke, Wells Fargo faced public outrage, massive fines, and a significant drop in consumer trust. The bank eventually paid over $3 billion in settlements and overhauled its leadership, with CEO John Stumpf resigning. The scandal highlighted the dark side of corporate incentive structures and sparked a broader conversation about ethical business practices in the financial sector. Oh, and don't forget, if you're enjoying this deep dive into white-collar crime, hit that subscribe button to stay updated on all things crime-related. 4. The Siemens Bribery Scandal, 2008. The Siemens bribery scandal comes in at number 4. Between the 1990s and 2008, Siemens, the German engineering giant, paid over $1.6 billion in bribes to government officials across the globe to secure contracts. The bribes were paid in countries like Nigeria, Argentina, and Venezuela, where Siemens sought lucrative government contracts for everything from telecommunications systems to power plants. When the scheme was uncovered, Siemens faced heavy fines. Over $1.6 billion, the largest penalties ever imposed for corporate bribery at the time. The scandal exposed not just the corruption within Siemens, but also the extent of global corporate bribery. Siemens agreed to massive corporate reforms and paid fines in both the US and Germany, setting an example of the consequences of unchecked corporate corruption. 3. The Enron Scandal, 2001. At number 3 is the Enron scandal, one of the most well-known corporate frauds in history. Enron, once one of the largest energy companies in the US, used fraudulent accounting practices to hide billions of dollars in debt from investors and regulators. Enron executives, including CEO Jeffrey Skilling and CFO Andrew Fastow, created off-the-books entities to shift debt away from the company's balance sheet, making it appear far more profitable than it actually was. The deception unraveled in 2001, leading to Enron's bankruptcy and the complete collapse of its stock value. Thousands of employees lost their jobs and retirement savings, while investors saw their shares become worthless overnight. The scandal also led to the dissolution of Arthur Andersen, one of the world's largest auditing firms, which had approved Enron's fraudulent financial statements. Enron's collapse had a profound impact on corporate governance and accounting standards in the US, leading to the passage of the Sarbanes-Oxley Act. 2. The Parmalat Scandal, 2003. Coming in at number 2 is the Parmalat Scandal, often referred to as Europe's Enron. Parmalat, the Italian dairy giant, was at the center of a massive accounting fraud involving over $20 billion. Executives at Parmalat fabricated financial statements, created fictitious assets, and used offshore companies to hide the company's mounting losses. The scandal unraveled when a $4.9 billion bank account, which Parmalat claimed to have in the Cayman Islands, was discovered to be fake. The collapse of Parmalat in 2003 marked one of the largest corporate bankruptcies in European history. Founder and CEO Callisto Tanzi was convicted of fraud and sentenced to prison, while thousands of employees lost their jobs and shareholders saw their investments wiped out. The Parmalat scandal had far-reaching consequences for corporate governance in Europe and highlighted the risks of unchecked executive power and poor financial oversight. 1. The Lehman Brothers collapse, 2008. Finally, at number 1, we have the Lehman Brothers collapse, the most severe white-collar crime scandal of the 2000s. Lehman Brothers, a global financial services firm, was a major player in the subprime mortgage market in the years leading up to the 2008 financial crisis. The firm amassed massive amounts of debt by investing in risky mortgage-backed securities, which were tied to the U.S. housing market. When the housing bubble burst in 2008, Lehman Brothers found itself unable to cover its debts, leading to its bankruptcy. Lehman's collapse triggered a global financial crisis, resulting in trillions of dollars in lost wealth, widespread unemployment, and a severe recession. The firm's bankruptcy was the largest in U.S. history, and its collapse exposed the fragility of the global financial system. The fallout from Lehman Brothers' failure continues to be felt today, with new regulations and reforms aimed at preventing another financial disaster of this magnitude. And there you have it, the top 10 white-collar crime scandals of the 2000s. These cases reveal just how devastating greed and deception can be on a global scale. Which one did you think was the most interesting case? Oh, and don't forget, a good detective never puts down their magnifying glass. See you in the next video.